within the US, within equities, if the market's getting stressed out, then I would expect that we would see fewer sectors trading above their 200-day average. Happy Thursday afternoon, everybody. Willie Delwich here, live from Milwaukee, to talk about some Townhall Takeaways again. We get together every Thursday afternoon to try to boil the market down, the developments of the week, into just a few key takeaways, whether it's macro or market, inflation, economy, all kinds of things we could talk about. And this week is no different. There's the list of potential subjects is longer than we've got time for. Could talk about inflation, could talk about, what's happening in terms of bond yields getting above 5% for the first time in 15 years. But I think I want to step back and think about, as we see some of the volatility in the market, some of these intraday moves, some of these longer term moves, what we would look for, what evidence we'd see if things were getting kind of stressed out, whether it's because of too fast of a move from equities or too aggressive of a rise in bond yields, or concerning words from the Fed, or and whatever the reason, what would be the market signals we would see to give us some evidence that we're starting to see some stress that we want to pay attention to. And we'll start from the perspective of bonds. And like I said, we're seeing bond yields move higher. The 1-year Treasury, 6-month Treasury peaked above 5% for the first time in 15 years earlier this week. So that seems to be worrisome. But then if you look at from a corporate bond perspective, we're not seeing those signs of stress. If you actually look at AAA corporate bonds, are actually below short-term treasuries, which is a weird and anomalous development on its own. But here I want to think about BAA corporate bond yields, surged to their highest level in over a decade last year, pulled back, but didn't get below their previous cycle highs. So settling in to a range on either side of 6%. From a level perspective, from a momentum perspective, that's what we're looking at for signs of stress. When upside momentum surges, that's usually a headwind for equities and a sign of a larger stress. Saw that early part of last year as rates surged, as yields surged, momentum built. Since then, it's dissipated and it's barely positive at this point. So we're not seeing this uptick in bond yield momentum that would be a sign of stress from my perspective. We're not also, though, seeing that collapse in momentum where momentum actually turns negative. We haven't seen that. It's just yields have stopped rising at this point. So that's one area to look at for evidence of stress: corporate bond yields, both the level and then also momentum. Within the US, within equities, if the market's getting stressed out, then I would expect that we would see fewer sectors trading above their 200-day average. And we saw hints of that coming into this week. We had dropped from 10 sectors to 7 sectors. Talked about that as not a good sign for equities, for the S&P 500 to see fewer than 9 sectors above their 200-day averages. The good news is, we've had a little volatility this week, but we're back to 10 sectors above their 200-day average. When that's the case, the S&P 500 tends to be relatively okay. In fact, all of the net returns for the S&P 500 over the past 2+ decades have come when we've had either 9, 10, 11 sectors above their 200-day average, so that strength component, or when you've been so sold out that you've only had 0 or 1 sector above their 200-day average. Those examples have been less rare. The response has been more dramatic. But really, in terms of sustained strength, we want to see 9, 10, 11 sectors above their 200-day average. So seeing this week move from 7 sectors to 10 sectors, that's a sign that from a U.S. market perspective, not seeing evidence of stress. Then we can look overseas as well. Look at the percentage of world markets above their 50-day averages. If you're looking at the chart of it, you can see we've dropped below 70% out of the green zone into the yellow zone. Actually the second time since early November that we've seen this. The previous time, I think it was the first day of the year, we were in the 60s for one day, then promptly got back into above 70s. So very short-lived concern there. But if we see this continue to deteriorate, and if the dollar continues to heat up, I think there's a good chance we could see that. We go from the green zone, which is 70% or more, which we've slipped out of. Then between 40 and 70, that's kind of the yellow zone, as market behavior is kind of mixed in that area. If we drop below 40, that's evidence of market, the market weakness is more likely, that there's some stress in the market starting to develop. So that from a global perspective, seeing getting back above 70% of world markets above their 50-day averages, that would be a sign that we're not seeing stress emerge. Whereas if we continue to be below, then my guess is then we'd also see evidence from a U.S. perspective, start to see fewer sectors above their 200-day averages. So it's a little mixed here. We're kind of at the threshold, but not seeing some sort of broad need to say, okay, the market's tired. The rally off of those late 2022 lows has gone too far, is getting stressed out because of these external events. Within equities, the rally at this point looks to be holding pretty steady and looks pretty healthy at this point. So those are the takeaways for this week. Where we would look for stress: corporate bond yield momentum, the percentage of U.S. sectors or number of U.S. sectors above their 200-day average, and percentage of world markets above their 50-day average. Overall, not a lot of stress at this point in the cycle. Those are the takeaways. Thanks for tuning in. Willie Delwich, and I'll do this every Thursday afternoon. Hope you'll tune in again next week.